off that floor for 25 years. Okay. Anyway, the iron condor, it's 2 credit spreads. I'm doing an out-of-the-money bearish call spread. We saw that already. And I'm doing an out-of-the-money bullish put spread. We saw that one as well. So I'm combining 2 different credit spreads here, right? We're looking at multiple commissions perhaps, and you might have to do this in a margin account, but you can talk to your broker about what the requirements are for this. Let's just get into the whole trade here. We're back at 450, and we'll use the same spreads we talked about earlier, okay, the original one. I'm going to sell the 410 put. I'm going to buy the 400 put. I'm going to put this on for $1.05 credit. And because I don't think we're going too much higher, I'm going to sell the 490 call, buy the 500 call for $1.15 credit. So we're bringing in $2.20. Is there any magic in calls are worth more than puts? No. Don't worry about that. That's just the way it happened to turn out here. But the whole idea is I'm bringing in a total of $2.20. I'm 40 points out of the money on the call. I'm 40 points out of the money on the put that I've sold. And as I said, there's no magic in being exactly the same distance away. The margin equals the maximum risk. Well, what's the maximum risk? Because I have a $10 risk here and a $10 risk here, don't I? And I'm only bringing in $220. But you know what? I don't have $20 of risk. I only have $10 of risk. Because if the market heads higher, you know what? Those puts are going to expire worthless, aren't they? If the market heads lower, then the calls are all going to expire worthless. But I have risk on either end. Look at the landing area I have, right? We're at 450, 410 to 490, right? And I brought in what? $2.20 of time premium. So actually, I'm at 492 and a little under 488. That's a pretty large landing area, don't you think? But it's happened before, okay? The markets have made unusual moves, as we saw back in the fall of 2008 and early 2009, all right? These are questions that I've gotten before, and I think they're pretty good questions. You know, what's the best time to establish an iron condor? There's no right answer, except because I have an obligation, and I actually have 2 obligations. I'd rather tweak it in and have less time. You know, I wouldn't mind doing an iron condor in something like the OEX or SPX or the Russell or the, whatever. I'd love to do something 2-3 weeks or less if possible. Okay, you can go longer. This is 5 weeks. That's reasonable. But I don't want to go out 2 or 3 or 5 months. I don't know where this market's going to be in 5 months. I don't know where it's going to be in 2 weeks. So why do I want to be on the hook? Plus, the time decay isn't. It's kind of linear. It's not going to help me by moving out further. Okay, is high volatility or low volatility better? What do you think?
Low volatility?
Yeah, but low volatility, I'm going to bring in less money. High volatility, you know what? Right now the marketplace is saying chances are we could make that move that could hurt you. Okay? So this is one that's a tough one to answer, definitively. Sometimes it's something in between. I wrote a different article for somebody a couple of years ago with the iron condor, and it was on a well-known stock. I'm not sure I can use the name. But it was trading up in the 400s, 500s, whatever it was. Okay, if you use the internet, you've seen their product before. Okay, some search engine company, XYZ, I think was the name of it. But anyway, they were coming out with earnings, and I knew this, and I knew this article was going to be published. It wouldn't be printed for another month or 2, and I think I went 50 points out of the money on the call side to do the credit spread, and 70 or 75 points out of the money on the put side. Because my concern was more to the downside than the upside. We've gone 40 points either direction on this one, okay? And by golly, the company came out and the earnings were right in line, and the chairman said, yes, but, and everybody said, excuse me, whack. They just crushed the stock. It was down $30 or $40. But my initial thought was right. I don't think it's going to make that dramatic of a move and go down 75 or 80 points and really hurt me. As long as it trades in a range, and it did, I was okay. And the people from the publishing outfit called and said, hey, the stock just moved. Do you want to change your strike prices? And I said, I'm a trader. That would be like blasphemy for me to change my strike prices after the fact. I have to live with this. You know, let's put, and I don't know where it's going to be in 2 or 3 weeks or 5 weeks, whenever this hits the newsstand. Let's see what happens. Either I'm going to look real smart or I'm going to look real dumb, and I think I look somewhere in between. Okay, but you can change if you have a bias one way or the other. Number one, you don't have to do the entire iron condor. You can just do a call credit spread or a put credit spread. But you can also, not only can you change how far out of harm's way you are, but you also might say, I don't mind doing a 20-point spread on the calls and a 10-point spread on the puts. Now the margins might be a little different. Okay, the brokerage firms might take the margin a little differently if they're not the same distance apart. Okay, but you can talk to your broker about that. Is the iron condor a good monthly strategy? What do you think? Well, let's see. The credit received, right, here's the days to expiration. You know, we're selling this at about the 35-day mark here, aren't we? Okay? You can see that it's pretty linear for quite a while, isn't it? Why? Because when we talk about that time decay chart that you've all seen over the years, that's assuming that we're using something close to an at-the-money option. At the money, a little bit in the money, a little bit out of the money, that's the general shape. If you go deep in the money or you go far out of the money, it's much more linear. It's almost a straight line, isn't it? Okay, that's just the way that options work, all right? There we go, nearly linear, okay? The Department of Redundancy Department, okay? The least amount of time decay with something that's far, far out of the money seems to happen in that last week or so. I know some investors that put these things on and they ride it into the sunset. You know, the last expiration, everything worked out well, I didn't adjust it. I know other investors that with a week to go, they close out their position and initiate the next month. Once again, taking into account where are we now, where were we, how do I feel about the potential of the upside, the potential of the downside? You know, same strike prices, different lengths, you know, whatever. They go through the whole rigmarole, but they're doing it here because the options that they're going to have to close out are pretty darn worthless at that point.